Hey everyone, in this episode of The Joyful Trader, I've got something super exciting to share with you. Over the past year, one of my ETF portfolios has earned an impressive 28.86%. Yep, you heard that right, 28.86% in just 365 days and over 53% in just under 2 years. Stick around because I'm going to reveal the 6 ETFs in that portfolio that helped me achieve this, and we'll go over them one by one. Stay tuned. Hi everyone, I'm Dan Underhill here, your joyful trader, full-time surgical nurse, active trader and investor, side hustle connoisseur, and former CEO of my own software company for 22 years. So if you're curious about how to grow your portfolio, achieve similar returns, understand option trading better, and get ideas about developing side hustles that you can create while still holding down a full-time job, well, you're in the right place. Make sure to hit that subscribe button below, ring the bell so you never miss an update. Let's dive right in. So as a trader and investor, I hold numerous accounts for my funds, and each one of them have their own purpose and agenda. Some are for active trading of options, and other accounts like the one I'm going to talk about today are specifically geared for building retirement. This one particular account holds just 6 ETF funds. The funding is evenly divided across the 6 funds within it. So for example, if the account held $6,000, well then $1,000 would be allocated to owning each one of these ETFs. Pretty simple, and I have not made it more complicated than that. To begin with though, I want to provide a quick definition of what an ETF fund is, because I find that as I have talked to a lot of different people, they really have no idea. So what exactly is an ETF? Well, an ETF is short for exchange traded fund. There's about 1,100 of them to choose from. Think of an ETF as a big basket that holds a whole bunch of different investments like stocks, bonds, or even commodities like gold. Instead of buying just one stock, you're buying a piece of this entire basket, which means that you own a tiny part of all the investments in it. ETFs are traded on the stock exchange just like regular stocks are. This means that you can buy and sell them throughout the day whenever the stock market is open. The price of an ETF goes up and down based on the value of the investments in that basket and how much people are willing to pay. Essentially, the price movement is just like how a stock's price fluctuates throughout the day. Personally, I don't recommend these as a tool for day trading. These are more of a long-term buy and hold, but the nice thing is you can buy them throughout the stock market's trading hours. So some of the benefits of ETFs are diversification. Since an ETF holds many different investments, it helps to spread out your risk. So if one investment doesn't do well, the others in that basket might still be doing great, and it helps to balance everything out. Number 2, lower costs. ETFs usually have lower fees compared to other investment options like mutual funds. This means that more of your money is actually being invested rather than going towards fees. 3, flexibility. You can buy and sell ETFs at any time the stock market is open. It gives you a lot of control over your investments if you want that level of control. And 4, transparency. Most ETFs will show you exactly what's in the basket every day, so you always know what you're investing in. But to me, the biggest benefit is that ETFs are a great way to start investing because they make it really easy to own a diverse group of investments without needing a whole lot of money. I mean, that makes them perfect for people who want to invest, but they don't want to spend a lot of time handpicking individual stocks and who don't have much money to get started. In a future video, I'm going to talk in greater detail about how ETFs and mutual funds are different and why I prefer investing in ETFs. All right, so back to our conversation. I set up this account in July of 2022, so nearly 2 years ago as of the date of this video, which is June 27th of 2024. I researched various ETFs that would give me exposure to a wide variety of markets that were managed with a growth agenda, and I funded them evenly across 6 ETFs. Since then, I've continued to fund this particular account regularly in the exact same fashion, that is, evenly invested across the 6 ETFs. I have not traded in or out of them other than to draw some funds out at one time for a purchase, or I've not changed these assets at any time in this portfolio. video. My results to date, starting this particular account in July of 22, were a 2-year return so far of 53.05%. And the current full year's return as of June 26 has been 30.72%. I've done nothing but let this account grow, and I've had the dividends reinvested. The returns are calculated solely on the performance of the ETF, and I'm not factoring in additional investment money that I have put into this account. So in other words, the percentage of return is the same if I had only funded it from the beginning and simply left it alone. With that said, let's take a look at the first ETF. Number 1, the SPGP, the Invesco S&P 500 GARP ETF. Now, the goal of this investment is to earn returns similar to the S&P 500 Growth Index, which includes big U.S. companies that are growing quickly. The fund puts almost all, but at least 80% of its money into the stocks that make up that index. So the index tracks the performance of these large, growing companies in the U.S. stock market. The SPGP mainly focuses on these types of companies and doesn't spread its investments across many different other types of stocks. Once again, the overall goal of this ETF is growth. As of May 21st of this year, Morningstar gives SPGP an overall 4 out of 5 star rating. Historical returns are considered above average, and historical risk is considered average. Number 2, the IWY, which is the iShares Russell Top 200 Growth ETF. So this investment aims to match the results of the Russell Top 200 Growth Index, which tracks the biggest and the fastest growing companies in the U.S. stock market. The fund invests at least 80% of its money in the stocks that are part of this index or in investments that are very similar to those stocks. It can also invest up to 20% of its money in things like futures and options and swap contracts and cash. As of May 31st of this year, Morningstar gives IWY an overall 5 out of 5 star rating, the highest on my list. Historical returns are considered high, while the historical risk remains average. Number 3, the SCHG, Schwab US Large Cap Growth ETF. So the Schwab US Large Cap Growth ETF tries to match the returns of the Dow Jones US Large Cap Growth Total Stock Market Index as closely as possible before fees and expenses. So to do this, the fund invests in the same stocks that are part of that index. The index includes the biggest and the fastest growing companies in the U.S. stock market. Those include Apple, Amazon, Microsoft, among hundreds of others just like that. Specifically, it covers the top 750 companies by size that are considered growth. So this fund gets you ownership of a very large cross-section of big companies for a small fraction of the cost of actually trying to buy each one yourself individually. Hey, if you find this type of information helpful and you want to stay in the know about practical yet cutting-edge investment, trading, and side hustle ideas, please subscribe to the channel. Give this video a like, tap the notification bell to stay up to date, and share this video with friends who are probably struggling by earning super meager returns when they could be doing better like you are because you're watching this video. All right, so number 4, MGK, which is the Vanguard Mega Cap Growth ETF. This investment aims to follow the performance of the CRSP US Mega Cap Growth Index. So mega cap companies have very high market capitalization values, usually over $200 billion. These companies are among the biggest and the most well-known in the world. And examples include companies like Apple, Microsoft, Amazon, Nvidia, etc. This fund uses an indexing approach, which means it tries to match the performance of this index. The MGK fund invests most, if not all, of its money entirely in stocks that are part of that index, and they hold each stock in similar amounts to how they are weighted in that index. So the fund is non-diversified, and that means it focuses on a very specific type of stock. So as of May of this year, Morningstar gives MGK an overall 4 out of 5 star rating. Historical returns are high, while the historical risk has been deemed to be above average. Number 5, the SPYG, the SPDR S&P 500 Growth ETF. So this one you may have seen or heard about, the related option for it named SPY, or referred to as the SPYDER. Now the SPYDER is one of the most widely traded option contracts that there are available. Super popular. The SPYG ETF, however, aims to give returns that are similar to the S&P 500 Growth Index. index, and that tracks large U.S. companies that are growing very quickly. The fund invests almost all, but at least 80% of its money in stocks that make up that index. The index focuses on performance of big growing companies in the stock market. The fund is non-diversified, meaning it focuses on these specific types of stocks, aka the ones found in that index. The biggest benefit of investing in the SPYG ETF is that it gives you exposure to ownership in companies that are focused on growth. Growth stocks are those companies that are expected to grow their earnings and revenues faster than the average. These companies often reinvest their profits to expand and innovate, and that leads to higher stock prices over time. Think of it as a positive feedback loop. The more self-investment of profit leads to greater innovation, which leads to higher profits, and so on and so forth. And finally, the sixth ETF in this portfolio is probably one of the most commonly known ETFs that there is currently. The QQQ, Invesco QQQ Trust Series 1 ETF. However, it's most commonly referred to simply as the Qs. This investment aims to match the price and yield performance of the NASDAQ 100 index. This is the big technology-based index that tracks all of the top performing high-tech companies such as NVIDIA, Google, Tesla, Facebook, Intel, Adobe, Qualcomm, you name it. To keep the fund in line with the NASDAQ 100 index, the advisor of this fund regularly adjusts the stocks in the fund to reflect any changes that's happening in the index. This means they update which stocks are included and how much of each stock to hold so that it matches the index as closely as possible. This ETF gives the average investor the ability to participate in the amazing growth of these high-tech companies, even if you don't have a lot of money to invest. It would take thousands of dollars, if not tens of thousands of dollars, in order to assemble your own private account, which owns various shares of each of these amazing companies. And even then, you would have to spend considerable amount of time managing those individual stocks to adjust them to how they're allocated in the NASDAQ 100, something nobody has time for. Let the managers of this fund do it for you. So by investing in these types of ETFs, you can buy small fractional pieces of many, many other stocks and other assets, all of them at once with an incredibly small investment. These six also produce quarterly dividends, which can be automatically reinvested back in so that they can buy more shares, which is essentially free money. Free money. Who doesn't like free money? All right, so I want to emphasize that my results may not be your results. Everyone's financial situation and investment goals are unique. My investment goals for many years has primarily focused on growth. The ETFs and the stocks that I've mentioned have worked well for me, but they might not be the best fit for everyone. The key here is to gather information, research thoroughly, make informed decisions that align with your individual needs. Also, let it be known that I am not receiving any kind of compensation to recommend these ETFs. In an ETF world consisting of over 1,000 choices, I wanted to give you at least some ideas to start doing some research with. I have no doubt that there are tons of other ETF combinations that have yielded higher results than what you see here, and possibly higher risk or even lower risk. I know that there are some really interesting looking ETFs that are coming on that are focused specifically on AI technology. And I know that I will probably be adding those ETFs to my positions. And I look forward to creating a video and talking with you more about what those ETFs might look like and what they're called. So I hope this video has given you some useful ETF ideas to consider, a starting point to research further. Investing can be a fantastic way to grow your wealth over time in a very passive way, but it does require patience, knowledge, and careful planning. And I would love to hear about your thoughts, your ETF recommendations down below in the comments so that we can all benefit from each other's great ideas. I also wanted to say that I am not a certified financial planner or advisor in any way, and that I only talk about these particular choices here and my own results because they're individual to me. So please don't take this as, certified financial advice. So please don't sue me. And as a final reminder, please like this video, subscribe to The Joyful Trader, and hit the notification bell so that you never miss another update. Thanks for watching, and remember, trade well, live fully, and I'll see you in the next episode.